Hey guys, welcome to this episode of Jack's Business Talk. Today we have a very special guest, Dylan Petrojon. Did I get your
Hey,
last name right?
close, Perejan, but it's all good. No, I'm excited to talk commercial real estate today. I know you've been looking at other markets, and Indy might be one of those markets that you eventually look at buying something in. So happy to show you everything I know.
And for those of you who are watching who are like, but Jack, you're the Pittsburgh guy and you're crushing in Pittsburgh. Why do you want to switch to another market? This is for later down the road, uh, for when I make a switch to commercial, which, is something I've talked a little bit about. And Indiana is one of those states I've been thinking about switching to. And since I'm getting a lot of questions about how to set up a buy box in Pittsburgh, I figure we'll take this opportunity for I could show you roughly how I'm going to set up a buy box for Indiana,
Hmm.
which is kind of like something I don't really know a whole ton about. So let's have fun with it.
Yeah, yeah, and I don't know. At least when I look at the buy box, I know some people have different ways of doing this. I feel like mine is more of like a ratio, but yeah, if you know what I mean. So like
I've
if
always kind of based the properties off of yield, if that makes sense. So like
yeah, yeah, so
like
like
we're talk about yield and it made sense to me, so I just set up my spreadsheets the same way.
yeah, no, that's what I was thinking about because I know some people will say like, "Oh, I only pay, 70 a door or I only pay 80 a door." But if the rents are 1,500, then that just doesn't make sense for whoever would be selling it unless the property is distressed.
Hmm.
So I look at it as more of a ratio. Like if if I can get 1,000, I really want to be paying like that, that around 70 to yeah, low 80s, I guess. It kind of sucks with where rates are today, but like the last one I bought, I think I paid 68 a door, and like that's really my sweet spot because you once you get rents up, you get a nice equity bump, at least in my market. But yeah, I mean, let's talk the market and then the areas that I recommend looking at. And then we can build the buy box.
Okay.
Sweet. So, are you familiar with Indianapolis at all?
Uh, it's a city in Indiana.
Okay, okay. And as far as do you usually invest in major metros or like outside of it?
I usually stay out of them.
Okay, same here. So I don't, and I have friends that operate in here successfully, more of them than people that do it outside. It feels like I'm the outsider, like investing outside of the main circle. But you have the 465 loop here. I do not buy anything in this county.
I can't see what you're talking about.
Oh, my bad. I thought I was sharing my screen. Here we go. I had a map of Indianapolis up the whole time. And I wasn't even sharing it. So right here you have the 465 loop. I don't buy anything inside of here. The reason is it's just more or less like some of the politics that go on like with Marion County and the taxes being higher.
Hmm.
I just don't like to
Yeah,
touch
that's the
it.
same with Pittsburgh and really any city.
So when you come to this side of town, well, not really Lebanon, but like right in here, this is like the most expensive area to buy stuff in. I don't think you're going to find any rentals that cash flow here unless you're doing like an STR. Um, from what I've heard, it seems like a lot of people, if they don't know a lot about Indiana, they at least know Carmel and Fishers. Have you heard of these two places or no?
I've heard of Fishers.
Okay, okay. I know these are really popular for like people all over the US moving to, just because of the way they've set up like their downtown, with it being like really nice, walkable areas. Um, so the places that I look to invest are not here and not here. I try to stay outside of that. So like some good places that I would recommend looking at is like the surrounding. So we have Avon, Greenwood, Franklin, Shelbyville, Fountain Town's there's not really much going on, but you can rent stuff out for a decent price. And I'm starting to even expand past this. This is part of the conversation of like how Dion was saying like go 45 minutes out of like where you want to be or like an hour out of where you want to be. And then the prices get substantially cheaper. Well, in thinking about that, there's a few towns that I've started looking at like Greensburg. And the interesting thing about Greensburg is it is about like an hour away from Cincy, and then you're an hour away from Indianapolis. So it's a really nice area, and there's a lot of as far as like its vicinity to these other places, but there's also a lot of trucks that drive through here.
Hmm.
So there's a lot of traffic constantly going between those two places. This is one place that we've started to buy some stuff, and we still find houses for sub $100,000. It's getting more rare, but like that's not even looking off market. That's just going on the MLS and looking at houses, and you can find some listed for like 90, 70 something. Like you still get that here. And then another one that I'm looking at is up here in Elwood. So Elwood, Lebanon. Lebanon is where a new Eli Lilly site is going in. So this one's began to get pretty popular. So really just looking at multifamily up here. But like this area too. So this area for cheaper houses. But if we're talking commercial, it's going to be a little bit harder, I would say, to find some of that stuff in these areas. Where I see a
Hmm.
lot of commercial properties popping up are places like Anderson, Muncie, Greenwood. I would pull up my board, but I don't think I can share that. I'm not sure though. I just don't want to share it if I'm not allowed to share, like screen share my board. Uh,
Yeah, I wouldn't chance it then.
but I do know that there's a lot of stuff that pop up in these places. Um, with these specific, like with Anderson and Muncie specifically, if you look at a population map, both of, I would say Muncie's more stagnant, but Anderson had a declining population for a long time. There was a factory there, from my understanding, that shut down. Um, and it was like the major employment center. It's kind of like the story of Gary, where
Yeah.
like their major employer left, and then the cities just slowly deteriorated in population over time. Um, from some of the people that I've been talking to that invest in the area, they think that it is kind of hit that point where it's bottomed out, and they think that it's going to start growing because like you have these areas right here, like these three cities are pretty expensive to buy houses in, comparatively to like some of the other markets we're looking at. And they're not far off from Anderson. So this is a market that I've been looking at to buy stuff into. Um, but as far as our buy box for commercial real estate, really I'm trying to stay within like this donut, or yeah, like outside sorry, outside this donut. So like right on this side right here. Just because it's easy for me to drive to. You can see where I am pinned on the map. So
Hmm.
everything within a 30 to 45-minute drive so I can take care of any problems if they come up because we're trying to self-manage everything, because I don't really trust property managers, but also I want to save the money. Um,
Now, what about the value add stuff out there? Because like that was kind of one of the things I was thinking about is because what I was envisioning is, and you could tell me what you think too,
Mhm.
is whenever we do something like a project like this, I want to try and like I don't know, I'm making up numbers. So like so let's say it was a 10 plex or something like that.
Yep.
That, I could go out, help you guys get, forced to equity on the property and just go through and remodel it.
Mhm.
Is that something that's feasible, good idea? Eh.
Yeah. I don't like to do anything that's not that. I was actually listening to a podcast while I was painting a couple days ago, and there was this apartment investor that was talking about how he likes to buy the stuff that's like nobody else wants
Hmm.
because one, he buys it for really cheap prices, but two, he actually improves the community in the area. And I thought that was like a really good way of looking at it. But yeah, I mean, I only like to do value add because you really need a margin of safety when you're buying these properties. Like I'm not trying to buy stuff that's at its stabilized rents for the like stabilized market rents. And we're just wanting to like, cash flow the thing. I want to buy something that, it's something that could be worth, I don't know. We buy it for 1 million, it could be worth 1.5 after we do some renovations and raise the rents and stuff like that. Like that's ideally what I'm looking for, if that makes
Okay.
sense.
Yeah.
Now with commercial real estate, unlike residential, this is where it's really cool because you can actually just raise the rents on the property, and that alone will increase the property value because all commercial real estate is based off the net operating income for the property. So, like for example, um, I was looking. Can you see my screen?
Hmm.
I was looking at this property, which is a property in my town. They wanted 965, and their rents are like 750 a door. Insanity. Um, I don't think, like you can see right here, it would be a negative 15.55% cash on cash return. I told them, which they said it's not even worth submitting an offer, but I said I could probably buy it for 500 because I know that the market rents are, we could say at a minimum 1,000, and it's an eightplex, so $8,000 a door. Like this is something that you could feasibly, like, you know, do. Sorry, I'm trying to th read the numbers at the same time and remember what I was looking at on this property. So, cash on cash return 17%. And you're like, okay, well, I could probably pay less than that, but I also don't want to assume that I'm going to get like market rents, like because all the tenants are at like 6 and 700 and stuff like that. So,
Yeah.
even if I assume just meeting them in the middle, so they're at, 5,800, then we take 8,000 and then just take the average of these two. So 6,800. Okay. That looks a little bit more realistic. But the cool thing is, like, let's say this property, do you know cap rates pretty well?
Somewhat.
Okay. So essentially, if we take the debt service and the cash flow together, because you
Hmm.
wouldn't have debt service if you you wouldn't have the debt service if the property was paid off. So you would essentially be cash flowing at your cap rate. So I'm just adding in the net cash flow plus the debt service to get our current cap rate, which would be 8.6%. I don't think that I'd be able to buy this for at that price. Like our previous property we bought for like a 6 or 7 cap or something like that. So oh, okay. So like let's say we bought it here and we're like, well, okay. So yeah, like a 6.9 cap. So property's worth $600,000, 6.9 cap, 2% cash on cash return. Not ideal. You can change your management fees and stuff like that. I usually try to keep it pretty solid on there, but just to do like a simple explanation of how this works. Like, let's say we had this property that's worth $600,000. Oh, that's 6 million. I'm just gonna copy some numbers here so I have the finance, like the dollar signs in there, so it's easier to read. $600,000 at a 6.9% cap rate. That means you're cash flowing that. Okay. So cash flowing 41,400 per year. But if we're able to increase this to where, let's say we get it to $8,000, and then this is 51,000. Uh, kind of have to do the math backwards here. So we increased the rents again. We had bought in the property for 600,000, got the rents up to the 6,800. Second year, we come in again and increase the rents to the 8,000. Well, the cool thing is, if we're valuing our property at the cap rate that we bought it at, if we divide this 51,000 by 6.9%, we can see that it's worth 748,000. And that's using the same cap rate. That's assuming rates don't move or anything like that. So if rates start to head down, cap rates are also going to compress. So we're we're gonna see like, something that might trade for a 6.9, might trade for a 6, or might trade for like a 5.5 or something like that. Yet again, it tends to move with the whole market, but like these move with rates because people are looking for certain yields on properties. Um, I'm staying a little bit more conservative with everything just because I don't want to get in a situation like the people that bought in 2020 are in, where
Mhm.
they bought stuff with 3% interest rates and now they're seven. You know, um, trying to stay a little bit more conservative than that. But I think this is like the best time to buy though, because we're really at a point where it seems like rates have peaked and we're just waiting for them to head down.
Yeah,
We don't know when. I mean, realtors have been telling buyers since like 2023 that, what is it? Buy the house, date the rate or something like that. Or no, marry the house, date the rate.
that's what it is. Yeah.
Yeah, like okay, well it's been 2 years now. When are rates gonna head down? Um, but this is just like simple, quick math of like, and I know that this can be like super confusing the first time looking at it. It took me a while to figure this out, but once you get it, it's just pretty simple. So being able to increase the rents would be, in this instance, added value of $150,000. And the coolest part is you probably didn't really need to do that many renovations to increase those rents, especially if they're like, I mean, like some of ours, all we did was paint the inside a different color. And then we painted
Hmm.
the cabinets, and that was our remodel. So, like, all in with labor and paint, we're at like $1,500. And we went from renting something for 700. I actually just signed a lease for 1100 on one of these apartments. So, it can change the value of your property drastically. And I just actually went through this experience where I bought the property for 775. We put about, at this point now it's probably closer to 50,000 into it, but we've just been reinvesting the rents into updating the property.
Hmm.
We just haven't been taking any distributions or anything, but we put 50 into it, so we're at 825. I just had the property appraised for 1.14, and we got a credit line for 260. So that means we bought it for 775, worth 1.14. We got 50 into it, so call it 825. We added like 300 and something $1,000 in equity in like a small period of time. I think it was about 6 or 7 months, between buying the property and then getting this credit line. Those are the types of things that you can do with commercial real estate, though, that you just can't do with residential real estate, where everything is opinion based. And uh, I mean, appraisals are still kind of opinion based, like they still have to pick their comps and everything like that, but everybody relies on the math a lot more in commercial, whereas I feel like residential is just more of a emotional space, if that makes sense. Like it's all emotions and how I feel about the property instead of and how other people feel about properties in that market and what they're willing to pay. Um, where this is why I was drawn to commercial though, just because it's so much more math focused.
Hmm.
Um, so in building your buy box, what do you what are you looking to get?
Uh, I was thinking like obviously an apartment building,
Mhm.
and you're saying what 10 to 20s are a bit harder in your area.
So that's what I've been finding lately is that I'm having a hard time finding like the small commercial, I guess. So like the 8 to 20s. which
Hmm.
is really what I'm looking for right now. Um, I've even thought about just seeing if I can build one because I'm like, I can probably find the land easier than I can find one of these properties. And then it's brand new. You don't have any maintenance or anything, and you're going to get the highest rents because it's a brand new property, and you can put all those amenities that people love in that some of these brand new apartments are putting in. Like I have apartments that rent here, not mine, but like new builds that rent for 16, 1700, whereas mine are renting for 1,000 or 1,100.
Hmm.
There's just a difference. But yes, those have been harder for me to find. I've been able to find the 40 unit properties, 50 unit properties, mid 30s. Like that's what some of the bigger players consider like the small side, which is funny because I'm like slowly getting into the commercial space, and like what I considered a big purchase for me was like the 12. And then like I talked to some of the commercial guys and they're like, "Oh yeah, so, like some of the small properties like we don't like to touch those." And I was like, "Oh, what's small?" And they were like, "Well, something between like 25 to like 50 units, like below 50 units." And I was like, oh my gosh, that's like, top of what I would want to own, like property size wise. So
Yeah,
I
yeah.
guess we're just like in two different things. But yeah, I would love to find one of those because I know how those smaller ones work. Um, from like a function of like when you get into these bigger properties, you have to start hiring certain positions. So, like, you might need a leasing agent or you might need a full-time maintenance person, stuff like that. I've never underwritten a deal where I need all of that on payroll. So it's just a different it's just a completely different market for me, I guess, that I just haven't entirely looked into how to like underwrite one of those. I've just never done it before.
Hmm.
But these, the 8 to 20, 8 to 25, like I know you're going to have landscaping insurance, snow removal, at least here. And then, some of these other things that you see like repairs. And I've been told that I assume high on repairs for commercial, but keeping it conservative, because as long as we stay conservative, we will never put ourselves in a bad spot. Um, but yeah, I mean, those are what I would like to find more of, which is kind of why I'm looking at some of these external markets. Like I just saw an eightplex pop up in Anderson for 360, and that's something that I actually want to go look at because what is you quick with math? I'm trying to figure this out really quick.
What are you trying to figure out?
Oh, okay, so 45 a door. I was trying to figure out the per door price. Um, but yeah, I mean like that's something that would be really interesting to me if it's in a good enough area and a decent condition. Now, I took a look at the initial pictures and it looks like these things are going to need fully remodeled on the inside, but you're
Hmm.
paying 45 a door. And you're like, well, can I put 15 a door into each one and, get new floors, new paint, all that, new appliances, new countertops, and, it, we're all in 60 a door. And then is it worth 80 a door? Like, because that could be something that could actually happen. Because if your rents go from, I've seen rents in some of these markets for $500, $600, and if those can go from that to like more of the market norm of like 1,000 to 1,100, maybe even 12 in some of these areas, like that's a big difference in your like that is doubling the value of your property just by doing that.
So, just out of curiosity, what's the winters like out there? Are they, I mean, how comparable are they to like Pittsburgh, for example? Or like, I don't know how close you are to the lakes.
Gotcha. Well, I mean, Lake Michigan's only a couple hours north of me. Maybe about 3 hours because it's like 3.5 hours to Chicago.
Hmm.
It gets pretty cold. So like we get a lot of negative temperatures in the winter.
Yeah, I was gonna say Michigan's a worse lake than Erie. I'm probably about 2 hours from Erie,
Mhm.
but how's the snow? Is there a ton of snow or?
Yeah, yeah, no, like, and it depends on the winter, like the specific winter that we're having, because like Some years it'll be like we don't get very much snow at all, and then other years we could get, in some days you could get like 6, 7 inches of snow or more. I mean, I think GPT could help us out with this, but yeah, I mean you can get a lot of snow. So with that being said, with how cold it gets, something that I've realized is our electric heaters and like electric forced air heaters,
Mhm.
very expensive in the wintertime. Which, even though I'm not paying the electric bill for my apartments, it still factors into what I'm allowed to charge, well, able to charge because some people can't afford, certain amounts. And like if your electric bill is too high in the winter, well, you might actually be more expensive than some of the other apartments in your market that are on like gas or, well, I guess gas is the only other option.
Yeah.
But yeah, so it definitely gets a little cold. That's something that you'll want to factor in like in the wintertime and stuff. But gas is relatively cheap. Like I think for the building that I have, our gas bill in the wintertime is like 350, and that's for 12 apartments.
So, when it comes to roofs and stuff out your way, are they
Mhm.
are they a lot of the like the flat buildings with the rubber roofs and stuff, or are they pitched with shingles and stuff?
So mine is pitched with shingles. I think a lot of the properties you're going to run into are like that.
Hmm.
I'm trying to think of like some of the past properties I've looked at. I think most of the ones I've looked at are like that. I have seen where they do have the flat roof, but like in the winter time, you get a lot of snow on that roof. That could be a big problem.
Yeah, I'm not a huge fan of flat roofs. That's why I was asking.
Yeah, no. I
Is
wouldn't
is metal
really.
popular out there, or is it?
Metal roofs?
Mhm.
Yeah, it is. It is getting more popular. I've seen a few metal roofs. Just as people around town have redone their roofs. But yeah, it's not like super apparent that like a lot of people are doing it, but I have seen some. I think part of it is like a cost perspective because from what I've heard, metal roofs are more expensive than just shingling your roof. So it's more of a commitment for some people to do that. And from some of the contractors I've spoke to, they don't necessarily like the metal roofs if you have like where it's just like metal over metal and then they're screwing it in because they're like, well, then there's a ton of holes that you have to factor in your roof already. Now,
Yeah,
the legitimacy of like their claim, I don't know because I don't do roofs. I'd love to talk to somebody that does roofs about that to see, like what they think, but I don't know. It's not as popular here.
yeah, yeah. I was just curious. I like putting metal roofs on when I can,
Hmm.
but it's not necessarily a deal breaker.
Hmm. No, it makes sense.
But the thing is too, it's like, and this may be the the deciding factor what type of roof to use out there is we have a lot of like Amish and Mennonites and stuff. So it's
Hmm.
like their prices are considerably a lot less than
Hmm.
like going with a roofing company.
Yeah, I mean, we do have some out here. I know, like towards Newcastle, which is like on the east side, and then also like near Bloomington, which is like 2 hours away from me. There are like Amish and Mennonites that will, they'll have somebody drive them up, and then they'll like do like I've seen them throw up like a duplex in like a couple days, just from a framing perspective. And I was like,
Hmm.
wow, that's insanity. But yeah, I mean, we do have those crews here. I just don't know anybody that works with them, so it'd just be a matter of like finding those people.
Yeah,
Like, I haven't had any like major things like a roof that I've had to do lately. But yeah. So do you have any other questions about like building your buy box?
uh I guess like. What should I focus on then? So should I then kind of like stick with like 6 to 20 unit then, since that seems to be more of a popular.
I would if it's gonna be your first deal, I would really look for like the 5 to 20s, and
Hmm.
see if you can find something that you can just get into commercial. And like I can help you look for these too. Just so you can get into commercial and it's not too far off of running like a 2 to 4 family property. Um, I would stay away from the 30 plus
I
where
don't think I want to buy a 30 unit in general. Like I would rather have
Mhm.
like maybe three, like between 2 and 4 smaller units, that can quickly stack up to like maybe like a total of, 40 or 60 units
Yeah.
versus two, like for us larger ones.
Yeah. No, I mean, makes sense. And if you can pick them up, because I know a lot of big guys don't look at those ones. Well, big guys and girls, funds don't look at those smaller properties. Like the 5 to 25 range, really, like they completely avoid them just because it's not worth their time to try to, and they can't really get the right labor they need out there. So like they'll buy the 50 plus because they can have an on-site person that is going to be able to operate those buildings.
Mhm.
So something that I'm trying to do, and this might help you a lot, is buy a bunch of the smaller commercial properties, so like the 5 to 25s, and concentrate them in within a 30 to 45 minute radius. So I can have, like, I could hire one person to be on my team and they can solve problems for all of the properties. So we could have like 100 units, but we didn't buy a 100 unit property. We just bought a bunch of, 5 to 25 unit properties in a small area. And it's the same thing as having one 100 unit building, in my
Yeah,
opinion. I mean, yes, there's different costs and stuff, but we're not competing with like, some of the funds that are buying those 100 unit properties.
exactly.
Yeah. No, I think that's a good approach. I could help you start looking at Indiana when you're ready to buy commercial property in Indiana. Hopefully, I have a few more by then. I'm really wanting to add like 20 units this year. Um, I've just been having a hard time finding the second one, so we'll see.
Yeah, I'm hoping to finish up a few projects I have going on. I need to get a roof put on, a couple smaller jobs. I want to add at least, I want to try and add like, try to get like between 2 and 4 more units this year.
Mhm.
And hopefully next year, then I could be a financial independence.
Nice, nice. That's awesome.
And I'm actually going to try and have Cynthia start working part-time just so she can have her health insurance and fund money.
Hmm.
But like I should be able to cover all her bills, and probably like maybe the year after is when I'm going to start looking at Indiana and be like, okay, let's start cranking numbers now.
Yeah, yeah. And like one other thing that you could look at, because I know we were talking about like, what people make as a handyman, in like at least my market and then various markets. Um, that is one way that you could not be like quote unquote financially independent yet, but like more of a barista fire. So maybe your
Yeah.
properties cover your bills and everything that you have, plus maybe a little bit, but it's not enough to like really get by. So you could do like handyman work for other people to make up that gap between like what you're used to making and um what you're just making off of your rentals now.
Yeah, that's something I was thinking about doing is doing handyman work, especially since it's like in this area, there's always someone looking for something done. It's just like I
Yeah.
could do that. And it's like if I honestly didn't have the W-2, it's just like I could probably squeeze in a lot of work and be making about the same.
Yeah, that's what I noticed too when I started doing some of that stuff. And I am just helping one of my partners out, doing the work cheaper for him than he could get done if he hired out other subs. But like still for me, it's comparable, if not more, than I was making when I was working full time, just doing some of the handyman work. And it doesn't take me nearly as much time because I'm just charging more because
Hmm.
it's work that nobody really wants to do, like painting and drywall and stuff like that. And if they do want to do it, they're charging like, some of them 65, some of them $100 an hour to do some of this work. So charging less than that, I mean, that's not hard to do, and that definitely gets me out of bed to go do work for the day because I know that I'm going to make more than I was making in my W-2, and I can work a weekend and pay most of my bills for the entire month because I'm at like that barista fire level, where all of my bills are covered, but I don't have too much more over that. And I did have an emergency fund saved just in case if I had anything pop up during this transition period of switching from working full time to being an agent. But yeah.
Yeah, yeah. That way I figure I can get more money and coming in, and like honestly, if I did that on the side, what I'm doing,
Mhm.
it would greatly affect other things, and I could probably even move forward potentially next year, being like, "Hey, Dylan, it's time."
Yeah, I'm hoping I have a few more units by then. I I don't necessarily like envision doing a fund, like in the traditional fund structure. I just want to have like a few partners that maybe it's like three or four guys that I buy different properties with,
Hmm.
um, and just keep it at that. I don't want to have like a syndication where we have 100 people that,
No, no,
put
I completely agree with
$5,000 in.
that.
Yeah.
So,
I don't,
what are your is like your overall goal? Like, are
mhm.
you going to buy and hold? Are you thinking about?
So,
We already talked about forcing the equity and stuff.
yeah, so buy and hold value add real estate to where we can get a substantial portion of like let's say for example, I just keep going back to my deal because it's the perfect example of like how you can burr a commercial property. So like we bought it for 700, it like 775, and then at increased rents, redid some floors, painted, um, changed out appliances, property's worth 1.14. Well, the cool thing about that was we put 25% down. So 25% down of the 775 was like 232. So with that, we created like 300 and something. So we could have fully bird the property, pulled all of the original investors' money back out, kept the property, and then had that money to go do something else with. Now we got a credit line instead because we wanted to be able to repeatedly draw on it and we didn't want to permanently affect the cash flow of the property.
Yeah, exactly. Yeah.
But yeah, buying more stuff like that. And then that is one good point that you brought up about like what is the goal of like what I'm trying to do, because that is a major differentiator in like who's willing to invest with me and like what their goals are. Because me and my partner, like with the stuff we're buying, we don't want to sell anything ever. We'd rather just refinance and pull money out down the line. Uh, if that's, if we get a good opportunity, if rates are low or something like that, and we decide that a refinance makes sense, but we're not in the game of add value to a property and sell it out within a few years. Like we
Hmm.
could have tried to sell this one and then recouped all of our money plus that money, but instead I get to pull it out tax free and use it, to flip houses or whatever I want to do with it. Maybe even put it as a down payment on a commercial property and then, go through the cycle of burring it and pulling out the money. We know that the returns go down over time when you have, because you build up equity in the property over time, but that's okay because that's what we want. We don't care if we go from a 16% cash on cash return down to a 12 or an 11 or even a 10 over time because the property's paying itself off. what's more important for us is maintaining the cash flow, building equity, and then repeating the process over and over again. Because if we stay under levered like that, we're not going to run into a situation where we end up blowing ourselves up. Um, Pointing back to like the topic I had with talking to Mark a couple weeks ago, I think it might have even been last week or the week before, where I was talking about ROE versus ROI. And it seems like a lot of people that focus on ROE too much can put themselves in over-levered positions and end up blowing themselves up because, if you have 50 houses that only cash flow 200 bucks a month, I mean, that's just not a situation I want to put myself in.
Yeah.
I prefer to be around like three, four, 500 on some of the doors. And frankly, I want to get to where Dion is, where he's cash flowing some units 1,000 a door. That's insanity.
Yeah, I don't think like me and you are in the right markets necessarily for that.
No.
I mean, we can hold on to it for like 15 years and get to that point, but we're not
Yeah.
going to get that.
No, I don't think so anytime soon, but I can wish. Uh, but I mean, right now, I think most of my properties are cash flowing about 300 or 400 bucks a month per unit, and I think that's good enough.
Hmm.
But yeah, anything else?
I think that's all I really have for right now.
Yeah,
Where should I go to try and look at some of the stuff? Like,
the
because
commercial
it's not
property,
going to be, what's that?
commercial properties.
Yeah.
So I like Crexi more than LoopNet. So it's just Crexi, CREXI.com. And that'll at least get you started and you can start trying to underwrite those. Maybe watch a few YouTube videos on underwriting those. Um, that'll get you like in the mindset of looking at these bigger properties because at the end of the day, buying a 10-plex is just like buying 10 duplexes, but you just get to pay a cheaper per unit price because you're buying more. So, yeah, I would start there. And if you have any questions, feel free to reach out to me and I'm happy to help with anything.
All right. Yeah, sounds good.
Awesome, man. Awesome.
Well, until next time, thanks for tuning into this episode of Jack's a Trader on Pittsburgh.
All right.